Good morning, everybody. Welcome to the Flow Show. Friday, nearly pub time. It's like one more day to go, and it's the weekend. These weeks are going quickly again. Morning, Kay.
Hey, good morning, Ryan. Good morning, everybody. Very quickly, those weeks are going by. A bit scarier.
Yeah, very scary. It's like we're falling down a hill very fast, and I don't know what's
Yeah,
top of.
exactly. Getting old very fast, too fast.
Yeah, exactly. Right, let's get stuck into it. Where should we go? Let's go China for a change. China's CSRC, the regulatory body, has denied that it put a ban on the selling of stocks. That's according to the China Daily Press, the state newspaper over there. Obviously, that was the headlines that we've had yesterday and before, that they're putting further restrictions on selling of stocks. They rode back on that somewhat, probably because they've scared a lot of investors as well, including international investors. They say that the reason they put this on was because of a particular firm who was dumping a lot of stocks that wasn't in line with their market regulations. So the ban was put in place just on that firm. They halted trading for that particular firm. So it wasn't a widespread regulation, if you like, against selling markets. But this is China, so take that as you will. There's been a bit of data out, car data, not just something to keep an eye on. Retail car sales were down 43.5% month on month, according to preliminary data. Retail car sales were down 15.7% year on year. So obviously the EV market over there is something that's pretty big in China. They have been offering all sorts of incentives to get people purchasing new cars, EVs, but doesn't look like it's working for now. New Zealand, TD see the RBNZ hiking the rate at their meeting next week to 5.75%. So taking a hawkish line there, as some of the other banks have done as well. Kay, are they really going to hike next week, do you think?
I mean, it's some question. I'm actually relatively surprised that there's such a big legion of strategists expecting hikes now, or do they just want to be exceptional also when in those calls? We could. Everything is sticky, but then we got those retail sales out earlier today, which were crappy to say the least. We've also got, if I'm not mistaken, the day before, credit card spending also, which was
right there,
which was a bit lower as well. I'm going to reserve my answer on that one. I'm actually, I don't know. This is honestly one that I don't know. There is probably going to be speculation into the meeting, which is on Monday night for us, if I'm not mistaken. Let me just check. The 28th was there, so that's Monday night for us. Oops, hang on. I guess we'll see a bit more speculation into the meeting, but this is one that may be building up, one of those that may be building up to be a buy the rumor, sell the fact one if they do not. Or was still keeping his all the options open. That is undeniable. But apart from really sticky inflation and perhaps one or two other data points, but I don't know. It's limits, very, very, very limit border. It's a real 50-50 for me. And if you look at the whole spectrum, we hear from all those central banks, and the market is repricing constantly the higher for longer rhetoric. But higher for longer doesn't mean that they necessarily need to add on top, right?
Yeah, exactly. Yeah, I think it's. I wasn't trying to put you right on the spot whether they hike or not. It just it seems very. We've got a central well, pretty much all the central banks who have come to the end, supposedly, of their hike cycle, and everyone's talking cuts. And here's one where maybe the market is perhaps getting more expectant of hikes than the central bank might produce. So it's going to cause a reaction. We have seen Kiwi bid up on these expectations. So if they don't hike and don't give anything hawkish that leans towards a hike, we're going to get a big, likely get a big reversal in a lot of Kiwi pairs. So if you are trading a Kiwi, it's a bigger risk event than, say, an RBA meeting at the moment, because of the expectations coming in. So that's the main thing to look at, how much risk and where that risk lies.
And we need to know as well that positioning has been increased as well to the long side. I myself, I'm as people know in the room, I'm long Kiwi Swiss, and I started to offload some of them. It's one of those currencies also that we cannot forget. The liquidity in the market. It is not a very, very big market, the Kiwi. Okay, so we can have quite a few swings there in come the RBNZ meeting. Okay, so if you have Kiwi in position, be careful. Both sides, but just be careful, because this thing could move 1 or 2% on this point. And I would say likely this time it would be the sell the fact, which is the surprise or danger side of things. So I'm going to be very, very cautious. I may actually just switch into something else, or just let that one go and see what the RBNZ tells us.
So where Kiwi Swiss is, it's a sort of double play. I assume it's mainly a bit of a play on the Swiss, like your other Swiss trades. Would you see, if they disappointed, would you see that as a dip to get on?
I would wait for a bit, because as I said, liquidity is one issue. Positions have been increased. I would not buy the initial dip. No. No. I'm really going to wait to see that play out, because the decision is during the Asian session. Then we've got the European, the American session to add on to it. I will really watch how it plays out over the day. If they effectively hike, though, then I guess that that is going to put quite a bit more upward pressure, at least in the short term. I think we can then we can see waves. We can see, yes, they hiked, so with Kiwi shooting up, then people coming in, taking profit, taking it all the way back down, and then see if we get those next waves where people say, like, well, all right, it's still a good currency to be in, so we're getting back into it. We have to really monitor the waves on this one, and because I would say if they effectively hike, I can see people taking advantage of that spike to come in and take some profits.
Yeah, as well. Yeah, definitely a buy rumor, sell fact type event. Cool, thanks, mate. Right, well, coming on, we'll move across to Europe. A bit of data out. Final GDP numbers from Germany unchanged over the flash numbers, confirming technical recessions over there. So no change from those guys. We also got the IFO, which was a little bit mixed. The headline number came in as expected, showed a bit of an improvement. Current assessment was unchanged, beat expectations but remained unchanged. Expectations beat expectations by a pip and confirmed a rise over last month, but nothing gangbusters here. A slight improvement from the IFO. We also got those ECB, the survey on the expectations, CPI expectations, which went up a pip to 3.3% from the 1 year, from 3.2. And the longer term 3 year stayed unchanged at 2.5%. So still well above ECB target. It was ECB minutes day yesterday, a bit like the Fed minutes, nothing much to write home about. In the minutes, it said it was affirmed that further progress was needed to be made in a disinflationary process. The broad consensus among members that it was premature to discuss rate cuts The risk of cutting policy rates too early was still seen as outweighing that of cutting rates too late. Saw only limited indications of a wage turnaround. These lines have all been broadly expanded on by tons of ECB members since then. Those include the likes of ECB's Hawkie Holtzman, who says the main risk to rate cuts is the Red Sea tension. Says some wage increases have been quite high. It's better to cut later and faster than too early. Hopes for cuts, but says they've been wrong before. They don't see circumstances for the ECB to cut before the Fed. Lots of people playing the race game, who's going to cut first. I think he's probably right. There's less need for the ECB to cut before the Fed, or even as fast as the Fed, because their rate levels are that much lower. ECB Schnabel says the Eurozone economy is bottoming out. Then has a dig at Italy by saying it has some fiscal vulnerabilities. ECB's Nagel says Q2 data is vital for decision making on rates. So he's punting the can on the rate decision call until he's seen Q2 data. So we'll be in Q3 before we get Q2 data, or of course seeing the data that we get monthly. Officials mustn't be tempted to cut rates earlier. Now the ECB are a victim of their own success, shall we say. Their rate hiking cycle has caused them to have their first profit loss since 2004. They posted a loss of 1.3 billion euros for 2023, and they say the loss won't affect their price stability mandate. 1.3 billion, not exactly a big loss, Kay, but I dread to think what the Fed's book's going to look like.
Yeah, and compare that to the S&P.
Oh yeah.
No. It's one of those where the reporters can write about, and we should absolutely not trade that. There's no trade in there, and which is really the most important thing for us, right? It is not even something that to be ranked or to be filed into a whole package of expectations. Also, and it's to be expected, right? I mean,
Yeah.
if you inject so much, and if it's going to be a loss maker when rates go up. So it's actually a very small amount if you look at it.
Yeah.
In the global scheme of things. So now moving on that one.
Yeah. Just to answer Ali, how do they lose money? Well, quite simply, they're buying interest rate sensitive assets, and they were buying those when rates were low, and now rates are high. They lose money. Those value of those assets change for the negative. So they buying at the top and selling at the bottom, if you like. But that's the consequence of QE. The Fed, all the other central banks are in the same position as Kay mentioned, the SNB. Particularly when you're buying government bonds, the BOJ is the big potential canary in the coal mine, given that they own over half of their bond market, Japan's bond market. So when they start hiking rates, they're going to incur losses as well. But it depends how much they sell, what they sell, and whether those profits are realised. Remember, when you're buying government bonds, if you hold them till maturity, you're getting your money back effectively. So that's one way to avoid a loss, is just to let the bonds roll off and expire. And that's something Japan can look at as well. But mainly these sort of losses, they're not going to affect anything in the long run, unless a central bank goes bankrupt, which we won't even get into, that sort of thing. Right, moving on. US data yesterday, jobless claims. We're still seeing pretty decent numbers there. Nothing to write home about. Even getting marginally better, or looking better, in terms of the jobs market looking strong. We've got the S&P global manufacturing numbers and services numbers, which were a little bit mixed. Manufacturing showed a bit of an improvement. Beating expectation, was expected to fall 2 pips. Instead, it rose 8 pips. But services dipped back a little bit. was expected to only drop a pip, but came in at 51.3, so a little bit softer than expected. Services is the bigger component these days of these PMIs, so the market looked at that a little bit but brushed it off, those numbers. Existing home sales came in better than expected as well, so all looking good in that number. Canada retail sales, positive numbers. We had one beat on the headline number, 0.9%. Core sales, that's excluding autos, again positive, but just missed expectations by a pip, but still both up on last month. So good stuff going on there in Canada. Over to the Fed heads. We've had a whole flood of those. Fed Jefferson says it's likely to be appropriate to begin cutting the rate later this year. He said staff estimates show the PCE price index rose 2.4% over 12 months ended January, and the core was expected at 2.8% versus 2.9% prior. So that's Fed staff estimates. We had a look yesterday to see what the early expectations are for that data. There's none out yet, but they're probably all going to come in at those numbers, 2.4 and 2.8. I think only Goldie's had an expectation for PC next week, pretty much around the same numbers. So if those numbers come in, it will confirm inflation still going the right way to the Fed. For the Fed, only it's going in really small steps. But with the market seeing that stickier CPI last week, there might be a few more hawkish or bullish expectations for that data. But that's for next week. Fed's Harker. Oh, sorry, no, I'm staying with Jefferson. He says he wants to move in a way, he wants the Fed to move in a way that would not lead to stops and starts in policy and increase policy uncertainty. So he doesn't want to be cutting, stopping, that sort of thing. He wants a slow and steady move when they start cutting. He says he will be looking at the totality of data before making his rate cut call. Some of the others are pointing to individual parts of the economy they are focusing on to make their choices. Fed's Harker says we may be near the point of cutting rates, but is unsure of the timing. Then says rate cut timing is possible for the second half of the year. The greatest risk is cutting rates too early. Says the rise in layoffs is not a sign of a recession arriving. You'll remember we've been noting all these layoffs that have been happening at firms. Says if markets loosen financial conditions too much, the Fed will have to weigh that. So that's him saying that if the market goes too far, pricing cuts and the like in, that could affect their decision on when, how, and where they cut. He says he's most focused on the jobs market, and that will determine when to cut rates for him. Says a May rate cut is not in his current forecast. Says a couple more months of data, though, could convince him on inflation. He says they're close to cutting, but just give us a couple more meetings. Fed's Cook pretty much reading off the Fed hymn sheet, as she's wont to do. Says need more confidence on inflation before cutting rates, and is now weighing the possibility of easing policy too soon and letting inflation stay persistently high versus easing policy too late and causing unnecessary harm to the economy. Fed's Waller, he's urging patience on rate cuts after the recent jump in inflation. Still expects Fed easing this year, but there's no great urgency. Says January CPI could either be a bump or a warning on inflation. Seeks at least a couple more months of inflation data before making a decision. Coming over to stocks, Nvidia, they ballooned yesterday, added 277 billion in value, the most in market history. As we pointed out yesterday, they moved that valuation, change in value is bigger than some countries' GDP, including Greece, Portugal, and a few others. So just mind-boggling, really, those numbers. And something for all you UK retail traders, you're going to get easier access to gilts, according to the DMO. They're going to allow some firms to buy securities, retail firms such as likes of Hargreaves Lansdown, to buy securities from primary bond dealers. This will be through the secondary market, and resell them to retail investors at the auction price. So they will be acting pretty much as a broker, the link between primary bond dealers and retail traders. It's going to allow retail traders to put in bids, and then they'll get filled at auction prices, which is good news for retailers if you want access to those markets, just the same as the banks do. Okay, anything you need to bring to our attention?
I just saw that what is it? The German railways are on strike again next week. Perhaps not an immediate market mover, but there still seems to be people not happy about their wages and the way they are treated. So that is perhaps something to just bear in mind if there is anything, a resolution or more bad blood there for next week. And but for the rest, no, just I think we covered everything, right?
Yeah.
Lot more repricing done in the rates markets. Perhaps just one to keep an eye on for next Monday, and that is well, two things actually. Next Monday we will have the Japanese CPI out, and as it's a hot topic right now about wondering what or when the Bank of Japan will do something, that is likely going to be a yen mover then. Okay, it's the national CPI, and you can see that the core is expected to dip under 2%. Again, I maintain base case Veda will take us out of negative, but that may again shift a little bit expectations as to how fast, how far they can go. So that's one perhaps keeping an eye on. And then today, and I think it is around the close, and forgive me if I'm wrong about it, but today Amazon is supposed to join the Dow Jones Index and be live from Monday. So there may be the next country's GDP being added or undone to one of the stocks. So
Yeah.
I guess we are going to have to watch Amazon this time after the Nvidia watch.
Yeah, I was going to ask as well. When will we likely to start seeing some of the Japanese year-end stuff filtering in, as we want to do sometimes?
March and yeah, March, and then especially, well, it all depends whether they have a lot to do or not. That is always a bit of a question, because if I recall last year or the year before, there was a year where there was absolutely very little going on. But you can bank on March. If they have a lot to do, that can spread over the whole month. If there's a bit less to do, they will start around the 12th, 15th. A good I don't know exactly what, even if it's on a weekend, it will be the day before. But a good point of start is usually the second or third Gotobi day. Gotobi is multiples of 5, right? And that is next month on the 15th, Friday the 15th. Well, I mean, that's not a bad date to keep in the calendars to see if they really have a lot to do. But as seen in the rest of all those fixings and stuff, it's people are hedging a lot more dynamically what they do these years, right? So there might be less to do, although being ahead of a potentially very big event for them over there, that the Bank of Japan is going to change their monetary policy, we may see this year increased activity again.
Yeah. So that's something. I mean, that's something we can touch upon as the clock winds down, because this year-end stuff, it can have an impact. Repatriation of funds and profits and all that sort of stuff. Importers, exporters getting a bit more active in FX markets and the like. So it is something, of course, coming amid potential changes by the BOJ. It's just one of those moments where things might happen that you're not aware of. So yeah, just we like to be at the forefront of things, be ahead of things. Forewarned is forearmed, as we say. So just add that to your list of post-it notes stuck on the side of your PC of things to watch in the weeks ahead. Right, well, let's have a look what's going on now in markets. Going to start with euro dollar. We had all this shenanigans yesterday. We had a move up towards 109, couldn't quite get there. Topped out in the 80s, the late 80s. We've had a move back down through my watch zone. Now we're struggling to get back into it again around this 108.30. So it's got to do all the work again at the moment. But we're seeing the opposite of what we saw all this year at the moment. We're seeing an uptrend, higher highs, lower highs, higher lows. So it is doing the opposite, but we need to get above. We need to continue this by making breaks at the key areas. And this key area is 109, 0020, up towards this fib is the main area of turning this year's trend around so far. So for the moment, it's still constructive. 108 is probably our positive negative line at the moment. If we're back below there, it might look like this move is starting to wash out a bit. So it will look a bit more bearish below 107.90. But if we hold 107.60s, where we've had previous support and resistance, that again might keep this trend going. So right here, it's a bit of a coin toss where we go. We either break back down or we move up towards 109. And then what we do when we get to 109 is another question altogether. But for me, the trend is still continuing despite this setback. We've had these setbacks before. In this short-term moves, they look like good trend refreshes, which is what you want to see. So, yeah, bit in the middle here. As I say, bit of a coin toss as to which way it goes. Dollar yen getting a bit more perky, following yields at the moment. I'm still a bit short this one, but I had a thought about just chucking it in this morning, but I haven't. I'll leave it on. I'm still short from 61. I'm not panicking too much. I'll see what happens if we get up and test this former high in the 150.80s. But whereas it hasn't been following yields for the last couple of days because of what's been going on in the yen, at the moment we are seeing a bit of a pickup. So 2-year yields, which we advise you keep an eye on. That just gives you an overview of the short-term picture in terms of rate expectations. So now we're just moving above. We were down to 3 Fed cuts levels. We're just edging a bit higher. It could be that we're going to start seeing the market maybe switching to pricing below what's expected from the Fed. So the Fed expecting 3. Markets were expecting 4, 5. Now markets are coming in more in line with the Fed. But if the data continues as it is, positive on things like jobs, PMIs, particularly inflation being sticky, then the market is likely to start going below and pricing less cuts than what the Feds are telling us. Markets always like to go to the extremes, and they could go the other way. How much would you assign percentage-wise to the Fed, to the market underpricing cuts, Kay?
Right now, I've showed this and I've showed this picture in the room this morning as well, with exactly the number of cuts that that are expected, or that the market is pricing, or that the market is trading upon, depending how we want to call it. We are in the territory now where there is, we've already priced out half another cut versus the where the dots are. Okay, I think this could go up to perhaps another 10-12 bps, but that would, in my opinion, start to look a little bit rich there yields wise. if we could go, if we got up to like 485, 487 or so. Of course, there is always this thing about the US Treasury auction program, and we're seeing again that next week is another big program. Apart from really talking about what the market is really pricing in as far as Fed expectations go, the bond market and those sharks, they will really want the Treasury to pay up for their money, right? So it looks to me like if we see another leg higher next week, it may just be, well, it may be the market like trying to tell the Treasury you're not going to get too cheap money here as well. So we have to take that into account. We can never omit those kind of things, because a market is a market, and it's always a question of supply and demand, right? So next week there's again a lot of bond supply, bills and the belly supply next week. So that may also take this yield market a bit higher. Now, as far as really pricing in Fed expectations, I guess anywhere between here and that next 10, 12 BPs, if you take it reasonably speaking, that should be enough, right?
Yeah.
It should, in my opinion at least, it should be enough. There's not too much reason to go and completely price out Fed cuts this year, although the economy is still running. Equity markets are racing higher. And the Fed cut expectations are probably adding fuel to the fire there as well. But at one point, it's going to depend less on exactly what those Fed expectations are than really where the money just goes, you know. And so for what really to come back to the Fed expectations, I think within the next, take it 10, 12, 10, 15 BPs, that should be really enough. I don't think that we have to completely price out Fed cuts this year. I've always said when we were at 5, 6 cut expectations, that was absolutely not reasonable either. I've always said that it was very likely that the pendulum would swing at one stage back to where the dots are, which is around, if you compare it to this 2-year yield, it's around 462, and now we are above. So that's where your pendulum is swinging again. And then, but again, I wonder how much it is really pricing out cuts, or a bit of speculation for next week as well. Let's make the Treasury pay up for what they want to do.
Yeah, and of course the PCE next week could be a make or a breaker for this. If PCE comes in hot, then we're going to see these yields supported, and they're probably going to carry on going up. So yeah, lots to keep an eye on. But as I said, this is what we look at, because if the market does switch more hawkish, it's going to show that in prices and the dollar and everything else. So you need to be aware of what the market is thinking. Doesn't mean it's going to happen, but you know, as we saw with the market getting over extreme with cuts and what it did to the dollar and everything else, that's how those expectations can move markets a hell of a lot. So yeah, being ahead of the curve and seeing the signals that might point to that early will give you the best ways of trading it and not being caught out by it. But anyway, that's yields, and that is just asking if yields, there's more highs, can dollar yen go higher than the whole market by dollars? Well, at the moment, if you look just at this here, you can see generally it's all yields that are moving up. So that should be relatively neutral in terms of FX impact. Dollar yen is a different kettle of fish, because you've got the yen side of it, you've got the divergence between US yields and Japanese yields. But for the rest of the other currencies, it's all, as I say, largely moving in the same direction. So there's shouldn't be too much FX impact from that. If European yields were all coming down, all dropping, that's a different story. But as they're all pretty much going the same way, it's less of an impact. Right, let's. What do I want to look at next? I'm going to have a look at the S&P because it busted up through all the levels. The resistance up at 50.50. Let's zoom that in. So here we go again. Now we need to do a bit of price discovery and see what it wants to do up here. There is no historical text up here. There is no old levels in 1995 to draw a fib from, or have a horizontal line across from. This is all new, fresh stuff. So as I've been trying to show throughout this whole move since the 48s, you need to watch the levels, add lines here, take them out when necessary, watch when lines hold, when they break, and slowly and surely you get to find your bigger levels where the price is doing something, and these are the levels you can rely on. So we've got to do the same thing up here on this break. This is the area you need to watch for support, which is the break point, 50.50s down to 50.40s. It's got enough price action in there to warrant that this might be a significant level if we test it. Obviously, you have to judge why we're testing it. Now, up here, we're playing a game between pretty much the big figure, call it 51, because that's what likely this resistance is up here, just playing this big round number up here. So we got the highs close to 50.96, close to 50.91, 51, and we've got a bit of intraday support coming in around 50.80. So this is what you need to watch now. Are we going to go above there, or are we going to go below here? If we go below, then you need to watch the next support level. If we go above, then you need to sit and wait and see where the high is going to develop. What you're looking for, again, coming back, is a high, a good period of time before trying that high again and holding. If you want to pick tops, that's the price action you got to look for. I wouldn't be short up here except just a pure scalp of this high level. 5-10 pip stop underneath that. I wouldn't be looking for anything more. If I wanted to be a longer term short, I need to see this kind of action developing to tell me that this is an area worth shorting against, because I can define my risk tight. Through 50.60, you're short. You're wrong if you're short. That's as plain as a nose on your face. You don't need to be up here at 51 saying, oh, I think I might be wrong. You were wrong at 50.60 because it was a break. So yeah, the price needs to develop. So all this work up here is the same as what we did here when we had no prior historical technical levels to lean on. All these levels had to show up, and you watch them, you watch them, you watch them, you learn them, because all this stuff here becomes the tech that you use in days, weeks, years to come. One day you might draw a fib level off this 49, 48 area, and you won't know why that occurred back then. But here you are. You got front row seats for all this, how price action develops. This is where you don't need to guess tops, bottoms, or whatever. You let the price action do it. So for now, yeah, need to see some price definition coming in up for this one. Obviously, bit of book talking. I'm still long this. I did get out some after the Nvidia stuff, and I got a bit more out around the 50.40s yesterday. A bit premature because then we had the break. But I have knocked a bit off up here as well. So the trend is still going for this one. People have been trying to short it all the way up for the last 250 handles, and a few people have been coming unstuck. So it's not the time to get into long-term shorts just yet. Kay, did you want to finish off for the Friday? Seems I only allowed you 2 charts yesterday.
Yeah, I can show a few things. Just a couple. Because people are wondering, and we had this discussion as well, really late in our room yesterday. People are wondering why, when those equity markets are moving like they are, why isn't the dollar responding? And because people have, and especially the younger guard, or even people who are doing this for a longer period, are wondering why the dollar isn't moving or isn't following those exact moves. Everybody looks at this correlation: higher equity markets, lower dollar, and vice versa. Well, that correlation has exploded, and it's been actually going on for a little while, but it's especially done it over the turn of the year into the end of the year, because we saw equity markets come back down a little bit, and we did see the dollar at the same time getting sold off. There is a couple of explanations for this, all right, and so one of it is this: the things that I've been showing already for a long time. When I'm saying I don't expect like really big moves on stuff like euro dollar, for instance, one of the reasons is this. One of the reasons is that the differentials are not really moving that much. And where do we find that then back? That is in the options, in the FX options. No, I'm not going to show our page, but I didn't prepare it, Ryan. Sorry for that. And if you see like the options, for instance, what's been happening on the euro dollar options as well, that is where we are now, the blue line. That is where we were a month ago. The options market is keeping the euro dollar, for instance, cornered. Okay, even the yen, even though we still see the smile is very, very, very bigly skewed for the downside, because that is for two reasons: for the forwards or the swaps, and because the expectations of the Bank of Japan still. So that we are still very much skewed, and that's a normal phenomenon for the puts. But even there, if you look at it, for instance, we are 2% or 1.5% lower than where we were like just a month ago. So that's another reason why FX is not always following the moves in the equity markets. This, for instance, is the sterling versus the dollar. Although today sterling is showing quite a bit of strength. But if you look at the differentials, they are still very much in that box that we started to build, and it's actually, we had a few spikes, but we've been in this area for even longer. But that is one of the reasons. The other reason is, and I don't really have it right now, is because of a lot of those equity markets, albeit at different speeds, one and the other, but all these equity markets are going also the same direction. So if you would say that, yeah, the S&P is going up, so the dollar per correlation should be trading weaker, because that is an accepted correlation. Well, it doesn't always work like that, because if you look at stuff like the DAX, if you look at stuff like Nikkei, if you look at stuff like even the FTSE, this month is going higher, and that's a bit of an event. But also, like for instance, the Swiss SMI, they're all going into the same direction. The only ones that are not really going anywhere, well, apart from a few other exceptions, are the Chinese one, but they are wrestling with a different problem, right? But those are some of those reasons why you do not see necessarily expected moves if everything else would be completely equal. But then if you look at those differentials, that means that despite the US yields spiking higher, the European yields are going the same direction. Just to name that example. And the yen is getting the yen is actually, that's one that we could argue is going weaker with the correlation of the Nikkei, because the JGB yields are at a complete standstill. So that explains somewhere one of the correlation that is still there, that is in Japan, Nikkei, Japanese yen. But you can't sell dollars necessarily because equity markets are going higher. That is something that I wanted to show. And then yeah, I'm going to, you know, Ali, I've seen your euro sterling question, and you're back into a decent position there. All right, so seem to nail your positions quite nicely. as we were talking about this 85, 70, 75 zone in the euro sterling, one attempt failed, next attempt failed, next attempt, just a quick one above on Tuesday, failed again. We had another look above yesterday and failed again. So that level is still very, very strong. Cable is also on the rise. I'm not sure whether it's cable or sterling cross related. I might think that it's perhaps a bit cross related as well. And let's also not forget that when things are positive in the market, although on the latest data, we could argue that sterling data were a bit up and down. But sterling is also a currency that's used to express positive or negative feelings sometimes in the market, and perhaps there's a bit of that. Perhaps there's just people who are trying to go for the break. Few of us were long euro sterling. We gave it up yesterday because we couldn't break above that 85.70 level, and we did well because now sterling is really getting a bit of a positive vibe there. So, and to end my presentation, and with the blessing of the people involved in this discussion here, I am going to show you what we did, because today I have seen read articles 2 days later that people saying like, oh yeah, the rand is weakening, and then now 2 days later people are or yesterday evening or so, people are saying like, oh well, yeah, but it's logic that the rand didn't really keep its bid tone or whatever 1.5 days later. This is the discussion that started on this South African budget, okay? And we started the discussion when they started to discuss the budget. So we had this 150 billion rand drawdown of the FX contingency reserve account, okay? So, and then we started the whole, between a few of us, we started a whole analysis about what that could mean for the rand. So first of all, we were looking at what the market was doing, and then we got a bit surprised about the move of these markets. So we are, and that was in the 18s, okay? We are now trading around 1930, 1928. This is where, in the ForexAnalytix community, this is where we started to counter trade this move, because we were analyzing whatever that the market was doing with it, and we did not understand the move that there was going on. And then we analyzed it a bit more, and then we took the decision that perhaps the market in that case did not completely understand or fully grasp the meaning of what the South African government was doing with their budget. Okay, so this is the day it happened. We had a good 2 hours of discussions about it, okay? Just to show you people that our community is not just about I did this or I did that, or we are the greatest and we are the best. We just analyze life, we trade life, and a good few of us went into that direction. And just to show you guys that the community we are in, really we do help each other out, and it's not just us, because you can see that other people were in that discussion, other people were chiming in, other people were agreeing on a certain direction, and as a result, people made some money out of it. And at least we're not trading against the grain or against what happened in the market, okay? So I just wanted to react on that, because today I saw these articles saying like, oh well, yeah, it's all normal, but I didn't see those people tell or say exactly the same here, you know, when it was supposed to be normal that this move would unfold. Just we are above these 1908, 1910 levels. We tackled the earlier Feb high. We also tackled the January high on in the dollar rand, and now we are still trading above. We are in a bit of a zone here. Okay, we are in a bit of a zone here. I'm in scalps long. I took some off around here. Need to respect this zone. Okay, but I'm going to be interested if we ever come back to the retest of this trend line. Okay, because I don't think that the rand issues are over. And if you look at, and that's another thing where the correlations have been thrown out of the window. If you look at the dollar mix, for instance, okay, we were trading around here. We've been talking about that on the face show as well. Very, very stubborn. The mix around 17. Okay, the dollar mix, and finding bids despite gigantic equity markets rally, which normally is a positive factor and which normally should underpin emerging markets. Well, the opposite is actually happening. Okay, this is perhaps a little bit of a yield play. We also had the Mexico Central Bank minutes out. I wouldn't call them dovish, but let's say that they are starting to slowly to look at the other side of rates. That may have helped the move as well, but just to show you that correlations, inter-asset correlations don't always work. So we have to look, and that's what I was saying in the room as well last night, we have to look at each asset a bit separately right now. Ryan, I've spoken more than enough. I'm giving it back to you. Wishing everybody a great weekend.
Thank you very much, mate. And I can only echo the thoughts that you gave there. You know, we do this flow show to give you a bit more of a fundamental backdrop and analysis on what's going to affect and move markets. And as Kay mentioned, that what they did, these guys over the South African stuff, was fundamentals in minutes rather than talking about on the show. You know, we do for weeks and months. You know, that's how you put fundamentals into action when you're trading and you know, make good trading decisions. They saw an outcome. They saw the market react to an outcome. They decided that outcome was wrong, and they went the other way. You know, that's what we do in this chat room all day long. So do come along. You can always join. $1 for 10 days. That's not a big investment at all to make in your trading future. And on that heady note, we will call it a day, call it a week. Take care the rest of this afternoon. No data out from the US, so we're going to be looking for headlines and other things to move markets. But keep an eye on those equities. We're at lofty levels. Let's see if they want to keep going up, or are we going to see some profit taking? Have a great rest of your day, everyone. A great weekend. Thank you, K-Man, again for all your stuff. Have a great weekend, and we will see you next week.
Cheers, mate.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.